This gold setup can look perfectly logical. The headline sounds bullish. The first candle moves in your direction. And for a few seconds, it feels like you were right. But then the trade still loses. That is the gold news trap. And it catches traders because they confuse a correct market idea with a clean trade execution. In this video, we are not talking about predicting gold. We are talking about why XAUUSD can move the way you expected. But your entry can still be bad. Here is the key idea. Gold does not only react to the news headline. Gold reacts to how the market positions before the news, how the dollar reacts, how liquidity changes, and how fast execution conditions change in the first few seconds. So if your entire plan is, news is bullish for gold, so I buy gold, that is not a plan. That is a headline reaction. Think of it like a road after heavy rain. You may know the destination. But if the road is slippery, the first car can still lose control. For gold traders, that slippery road is volatility. Volatility means price can travel a long distance very quickly. That sounds exciting, but it also means the distance between a good entry and a bad entry becomes very small. A candle that looks powerful on the chart may already have moved too far. By the time you enter, you may not be joining the move. You may be buying into the reaction of people who entered earlier. That is the first trap, chasing the first candle. The first candle after major news is often emotional. It can grab liquidity, hit stops, trigger breakout traders, and then reverse or stall. This is why a big green candle on gold is not automatically a buy. It may simply mean the market just swept orders. The second trap is spread. Spread is the difference between the buy price and the sell price. During quiet conditions, the spread may look small. But around major news, spread can widen. That means the trade can begin with a bigger cost than usual. So even if gold eventually moves in your direction, your entry may need to overcome a larger initial gap. This is where many new traders get confused. They think, I was right, gold went up. But the trade result says something different. Because the result is not only direction. It is direction plus entry price, spread, slippage, stop placement, and timing. Slippage is another part of the trap. Slippage means you click at one price, but the order is filled at a different price. In fast markets, that difference can matter. You may think you entered at the breakout. But in reality, you entered after the breakout already moved. Now your stop is closer, your risk is less clear, and your trade depends on price continuing immediately. That is not calm execution. That is pressure. Now let us connect this to gold. Gold often reacts strongly to the US dollar and interest rate expectations. When traders expect lower rates, gold can receive support. When the dollar strengthens, gold can face pressure. But the market does not always move in a clean straight line. Sometimes the first move is only a positioning flush. Sometimes price spikes one way to trigger late traders. Then the real reaction starts later. Sometimes the headline looks bullish, but the market already priced it in. This is why professional thinking is not, what does the headline say? The better question is, how does price react after the first emotional move? The first move gives attention. The second reaction gives information. If gold spikes upward, do not immediately ask, where can I buy? Ask, did price leave a clean structure, or did it only create noise? If price pulls back, ask, is the pullback controlled, or is the move losing strength? If price breaks a level, ask, did it hold above the level, or did it only sweep liquidity and return? This is where context matters. Context means you are not judging one candle alone. You are looking at the area, the timing, the news environment, the spread condition, and the risk. One candle can lie. One headline can mislead. One clean-looking breakout can still be a trap. So before trading gold around news, use a simple checklist. Question 1. What is the event? Is it a central bank decision, inflation data, jobs data, or a surprise geopolitical headline? Question 2. Is spread normal or wider than usual? If spread is wider than normal, the trade needs more room just to breathe. Question 3. Did price already make the big move? If the move has already happened, your entry may be late. Question 4. Where is the idea wrong? If you cannot define invalidation before entering, you do not have a trade idea. You only have a reaction. Question 5. Is this a real setup, or just fear of missing out? This question matters more than most traders want to admit. FOMO often appears when the candle is already large. The chart looks obvious. The mind says, if I do not enter now, I will miss it. But the market does not reward panic. It rewards process. A clean trader does not need to catch the first candle. A clean trader needs to understand whether the move gives a reasonable opportunity after the first shock. Sometimes the best trade is no trade. Especially when conditions are too fast, spread is too wide, or the stop is not clear. Waiting is not weakness. Waiting is part of the strategy. Now here is a practical way to think about it. Imagine gold spikes after a news release. Instead of entering immediately, mark the spike, mark the level it broke, and mark where price should not return if the move is truly strong. Then wait. If price holds the level and reacts cleanly, you have more information. If price falls back inside the range, the first spike may have been a trap. This does not mean the market must reverse. It only means the first move was not enough by itself. You need confirmation. Confirmation can be a clear close, a controlled pullback, a reclaimed level, or a shift in structure. The exact rule depends on your trading plan. But the principle is simple. Do not turn a news candle into an automatic entry. News creates movement. Movement creates emotion. Emotion creates bad clicks. Your job is to separate the movement from the decision. This is also why demo practice is useful. On a demo account, you can observe how XAUUSD behaves around major events without risking real money. Watch the spread. Watch the first spike. Watch how price behaves after 1 minute, 5 minutes, and 15 minutes. You will start to see that the headline is only the beginning. The real lesson is in the reaction. So the next time gold moves sharply after news, slow down. Do not ask only, is gold going up or down? Ask, is the spread reasonable? Has the move already happened? Where is my invalidation? What confirmation do I need? And am I trading a plan, or chasing a candle? If you want to practice this process, you can open a demo account or account link from the description or pinned comment. No promise. No signal. Just an education-first process for making cleaner trading decisions.